Oil prices have been pretty flat for the last several days. I'm Sean Pruitt, president of Kingdom Exploration. If you look at these prices over the last 5 years, this is a graph of a 5-year chart from 2015 to 2019. And so as you can see here, we hit highs of $65, $75 a barrel. But if you look at the top here, January 2018 to September 18, we were 67 to as high as $75 a barrel. That didn't last very long, and then bam, right here, that slide. So oil prices haven't been very exciting because bottom line, Shell is producing a lot of oil. And so what happened was when we went from $49 a barrel and climbed all the way up to 75 from August 2017 to September 2018, Shell started ramping up their production. Okay. And what happened? We had a major decrease in prices at $46 a barrel. Okay. And then we had oil prices go back up to 65 and then drop down to 58, 53. And so what's happening is when oil prices go up, Shell output goes up, oil output all over the world goes up, and then the supply and demand model, there's more supply than demand. And then, of course, oil prices drop. Okay, so every time oil prices go up, Shell goes up. Shell output goes up, and they start drilling more oil. Now, where we're at right now, so you got to understand something. Shell oil, you need $80-something a barrel. If we look at a 10-year chart here, 2009. 2011, we had $130 oil. We hit 2012, we're at $120. So from 2009 to 2014, we had $100 oil on average. So we were pumping shale oil, drilling. That's when the Bakken Shale was born. Permian Basin was going crazy at these prices. Okay, we had all that oil output, increasing it by 6-7 million barrels a day of output, and then bam, we dropped down to $50-something a barrel because of shale. We produced too much oil. And so we are going to continue to go up and down over the next several years because of the shale play. But what makes this different, from 2009 to 2019, that's 10 years of this shale game. And so finally, the guys with the big money, the institutional funders, the investment bankers, they're tired of this shale game. For the last 10 years, they've learned their lesson. And so even if oil prices came back, the shale game would not go crazy like it did in 2012 to 2014. You're not going to see that again. Why? Because they got burned. For every $2 they put in the shale game, they're getting $1 out. So why would they come back and say, oh, we hope oil prices stay at $100 a barrel, even though we've learned this lesson multiple times? You look at the major drop here. We had a major drop here. We had a drop here. In all of these, from 2014 to 2019, that's 5 years. For 5 years, Shell has not been profitable. You need $80, $90, $100 oil in order to for Shell to be prosperous. So do you think these investment bankers and these major companies that invested in Shell, do you think they're going to continue when it's been a 5-year loss? It ain't happening. Okay. And I foresee in March, when oil prices come back strong, I think we're going to see the shale game continue, but not near as great as it once was. And so if you look at the news, I'm not going to go in details on the news. We're seeing the same things over and over again. Oil prices slide despite OPEC cuts. Yeah, that's because we have pumping more oil. Oil markets brace for another 500,000 barrels per day oil field to come online. Yeah, they're putting more oil online. That's the agreement between Saudi and Kuwait. They have a field that they came to an agreement on. They're going to start pumping again. Oil slides as Russia touts easing OPEC. I mean, Russia has been playing games with Saudi Arabia because, quite simply, they don't need to curb production. They don't have a $2 trillion Aramco stock to focus on. So there's a lot of news. And it's boring. I mean, it's up, it's down, it's up, it's down until the shale oil glut stops. We're going to continue to have too much oil out there. But with that said, at $60-something a barrel, there's a lot of money to be made in the conventional place. And so we actually have a conventional oil play. We're drilling 2 wells, one well here, one well here. We're offsetting this well right here. This well paid back investors 300% in 3.5 years. That's a 70%. Actually, I think it's more than 70%. But anyways, can you imagine making 300% of your money in a 3.5 year period? That's not a bad investment. And so if you they studied all the well bores and all the logs here. If you go from this saltwater disposal well, this little black dot, this is a geology map. It's not I mean, it's not for glam. It's just strictly for business. And so anyways, from here to here, there's a 20 feet increase up dip to the structure. And so you always want to drill wells up dip to other wells, meaning oil and gas migrates to its highest point within its own structure. And so here, this is an anticline and this is syncline. This is the top, this is the bottom. Here's the oil structure. Oil and gas is going to flow to here because oil and gas migrates to its highest point within its own structure. And so we want to drill. This is where you want to drill. This is where the sweet spot is. If we drill a well here and here, this well is going to be up dip to this well. Okay. On the surface, it looks like you're drilling on the same depth, but actually, if you were to complete the well, that's why it's important to log it. Just because you hit this zone at 4,200 feet here doesn't mean you're going to hit it at 4,200 feet here. Otherwise, you'd be completing here and here where there's no oil. So the logs tell you where the structure is. And so we have a log report here and here showing this and this one right here. This is lower on structure than this is. Okay, so this is up dip. Okay, and so as we go further to the east here, this is even higher in structure, so we expect to produce more oil here. Okay, and so to the east, so they completed the zone out of the Gilcrease, and it paid investors 300%. Their real objective was the Wilcox. Okay, they were too low on structure here, and so based on the logs, we expect to be higher on structure here. If we get a good Wilcox completion, it could produce upwards of 1,300 barrels a day. Just to the 2 miles to the south down here, there was a Wilcox well that produced 1,300 barrels a day. 2 miles to the east over here, there's a field that produced over $70 million with the Wilcox. And to the north, they just recently successfully completed 2 Wilcox zones. So we see Wilcox in the log reports in this wellbore, and the geologist expects Wilcox to be in this area. But we do see that this is down dip to this area. And so like I said before, so imagine this being the Llama 1-14, and imagine this being the new location. So we're going to be up dip to this well. So we're up dip to this well right here, which is good. And we could potentially produce more oil out of the Gilcrease than this well did. And then we have the potential of Wilcox and amongst 3 other sands. And so it's a 2-well package. And we have also what's called micro seepage. And so this is the same map right here, only it's got an overlay of micro seepage. Micro seepage are invisible traces of light hydrocarbons that seep to the surface from an oil and gas reservoir. When hydrocarbons migrate upward and reach exposed air at the surface, several manifestations occur at or near the surface that we can monitor with remote sensing. While remote sensing cannot directly detect microseeps, it can reveal alteration patterns at a large scale that provide starting point for further exploration. The microseepage right here is in line with the geology. And so you can't just solely put your faith in microseepage, okay? But the log reports and the engineering reports, and based upon this well production and the log of this saltwater disposal well and the surrounding logs of the other wells and success, this microseepage lines up with what the geologist is seeing, and this is another layer to confirm. And so this is no man's land. There's the microseepage doesn't see anything there, but the darker spots here is where the microseepage darker means that there's more microseepage of oil and gas. And so and that's why we're choosing these 2 locations. This is the Wilcox sand structure. Okay, so the Wilcox was the main reason why these guys came out here. They didn't find Wilcox, so they just completed the Gilcrease and made their partners 300% in 3.5 years. So if our main objective is Wilcox, we do have Gilcrease as the safety net out here. But if you look here, this is minus 2784. and this line right here indicates that it's minus 27.73, and this is minus 27.50. So from here to here, we're up dip 34 feet. Okay, and so imagine this right here, 34 feet higher than this. That's great news. It's exactly, anytime you drill a well, you always want to drill up dip to another well. Okay, you never want to drill down dip. This is considered down dip to here. The Wilcox structure was very thin, but they did see oil and gas, and they saw that they were down dip. If they would have drilled over here, somewhere in here, the Wilcox could have potentially given them an incredible return. So anyways, I'm Sean Pruitt, president of Kingdom Exploration. If you'd like to chat, call me at my office, 307-6221-OIL, 307-6221-OIL. If you like these videos, please subscribe. I'd love to chat with you, love to connect. You could find more information in the description below to contact me or to subscribe or learn a little more about my projects. Thanks. Merry Christmas.